All right, everyone, it is Michael here. Welcome to Marbella in the south of Spain near Gibraltar. Sometime we'll maybe do a special on Gibraltar, but today we're going to talk about Spain. We're going to talk particularly about taxes in Spain. So this, if you look out, you can probably see super beautiful. This is, one of the probably great places in Europe to retire. Not only is the weather pretty darn good, it's beautiful, it offers lots of conveniences, it's clean, it's relatively safe, but actually real estate is remarkably cheap here, so that's also quite cool. So, people would want to come here, and they do, except that the taxes are a bit of a disaster in Spain, and so that's what we're going to talk about a little today, which, by the way, actually Spain in general. Look, Barcelona is a great city, Madrid is a great city, San Sebastian is one of the food capitals of the world. Lots to love in Spain. However, as we said, tax is not so good. So we're going to talk quickly about personal taxes and business taxes. So personal taxes, you have the highest marginal tax rate is 48%, and that's not counting, all the other nonsense that you can get in terms of socials, etc. So pretty expensive, right? You do have better rates for dividend income or income on capital, of course, but still quite high. You, on top of that, of course, would have probably had to pay at the corporate level, and the corporate tax rate in Spain is 25%, so, that tells you something. So, how would you structure things if you're in Spain? Well, a couple things. First of all, number one, you could be in a situation where you can take advantage of a special tax regime here called La Ley Beckham. So La Ley Beckham, as the name suggests, you've probably heard of Beckham. Oh, some people celebrating in the background. So it basically it treats you a little bit like a foreigner. So you only pay tax on the local income. Now, there's some nuances of how to qualify for it if you wanted to come to Spain and be able to take advantage of that tax regime. Loosely speaking, the people who do it will end up having to pay themselves a salary of about 100 grand a year, on which they will pay tax of about 37%. So they're going to end up paying about 37,000 in tax, and then the rest of their income they can potentially receive tax-free, provided they have an actual business that has real foreign substance. And so we'll talk about that in just a minute. But really, this is good for people who have, a genuine company. They've got operations outside of the country, etc. They can take advantage of this. Okay. Now, what about if you can't take advantage of that, or what about if we're just paying attention to the tax consequences for your business in general if you're here? So first of all, management and control is the name of the game here, and it's effective management and control, so in some places it'll be where are the directors. Here it's not, it's where the effective place of management and control is. And actually Spain, for all of their other stuff, is pretty progressive in terms of leading and implementing new tax policy quite quickly. So for example, when the base erosion profit shifting initiative came out from the OECD, Spain was one of the first to start bringing in the CFC recommendations and things like this. Okay, so that means that their rules are fairly tight. It's not super easy. So number one, you would have to have foreign management control of the company, as is normal, right? Number two, very often under their CFC rules, the way that it works, so if you were to own, a certain share of it, then it's going to be triggered as a CFC, and that share is fairly low. I believe it's 25% to cross that threshold. Now, you can play around with trusts to do some stuff with this, because the trust so Spain, being a civil law country, does not have trusts, all right? However, there's some court precedent around how they deal with trusts, and it gets a little bit nuanced and complex, but that being said, there is some possibilities to utilize trusts to help you from that standpoint. Now, if you're not in that situation, they do have a participation exemption, meaning that you could have a Spanish company which could bring money from the foreign company into Spain tax-free. However, usually there's a lot of restrictions on this. So normally they want you to have a fair tax rate, at least 10%. Normally they want to make sure that there's actually real personnel and materials outside of the country in that place if it is a low tax rate. Now, there's some exemptions for if you're from the EU, and there's some exemptions for if the company is from a country with which Spain has concluded a tax treaty that will qualify for treaty benefits under there. Okay, so any of those things can work. So normally when we're looking at setting somebody up with, say you're a resident of Spain, and we're going to say, okay, how do we structure your taxes? Well, you want to have a real company that's outside of the country. You want that real company to be in a jurisdiction where you have favorable tax rates. You might have a situation where A, that is held in trust for you, or it might be that B, it's in a situation where you have a participation, but you've actually got everything backing it up. Now you're still going to have to pay tax on the dividend side of it. You're not going to get away from that. So it's not necessarily the greatest, but what you can do at least is defer and reduce. And that's kind of the name of the game, right? You're going to say, okay, if I can eliminate or greatly reduce the corporate tax and pay a lower rate on my dividends, I save some tax. And if I can defer and reinvest at a 0% tax rate or at a close to or 10% or whatever, then you gain an advantage. So that's pretty much the overview of Spain and their tax system. If you have questions, reach out to us and we will talk to you about it.